What is going on, everybody? What's going on? Welcome to the Working People's Podcast. It's James Hollingsworth, and it's Working People's Podcast, where we are talking about what everybody wants to be able to achieve, and that's building generational wealth and also building a financial legacy for their families. And so tonight we're going to talk about some more market analysis and really dive into some more analysis on what's going on with interest rates. Jerome Powell just met with Congress a few days ago. Also, if you haven't watched the video that I did, 4 days ago? And it was on a market analysis. And I think I titled it, let me look and see what I titled it so I can be accurate when I tell you the name of it. Let's go here. Boom. It was called, on YouTube, if you look on YouTube, it's called, Is It Time for an Economic Market Collapse? And then on Facebook, it's the video that I did, I said 4 days ago. And the name of it, if you're looking on Facebook, let me just give you the name of it. It was called... where is it at? Scrolling down Facebook here. And, when you do so many videos and trying to keep everything straight. There it is. Yeah, I call it the same thing. Give it the same name. Is it time for an economic and market collapse? And so, if you watch that video, no, that's the one I'm doing. Yeah, that's the one that I did. I think, yeah, that's it. Is it time for an economic and market collapse? Oh my goodness, it's late. But really check out that video. It was done, I believe, 4 days ago. And it's important to watch that because in that video, in that show, I talked about, for certain, I saw that the Feds, the numbers are coming out for the Consumer Price Index on July 13th. And I talked about it will, I expect to see 50 basis points increase in the Fed interest rate. And then I said, it will not surprise me at all. It won't surprise me if we see another 75 basis points coming. And certainly that's what's about to happen in the immediate future. So it's important to, certainly I encourage you to watch the content that we're putting out here because we're doing a broad array of content, and we're trying to also make sure that we do I'm trying to do at least like one market analysis or some type of critical thinking market analysis video at least once a week, just to try to keep us abreast on different types of things, that may or may not be possible. But if you're watching tonight, make sure that you're press that subscribe button on YouTube. Also, if you are watching us via YouTube, press that thumbs up like button on the video and ring that notification bell. That way you'll get notified when we upload new content, new videos, and also drop some comments below on the videos. Tell us what's going on with your mindset or thoughts about where the economy is headed and what's going on in our present day economy, and how you're feeling about the inflation rates and inflation numbers and stuff like that. Certainly give us some feedback, right? And if you're watching here on Facebook, on my personal page, make sure that you press that thumbs up button, show some hearts on the video, drop some comments below, and also share this content and information with your friends. Also, in the video that I did, the show that I did 4 days ago, I talked about the potential of cutbacks in the job market. It's not going to be uncommon if we do truly indeed go into a recession to see job loss, unemployment rise up and people starting to get laid off, and job cuts. And I really believe that that's on the horizon. But I want to share with you some really detailed information as it relates to uh, where things are right now and projected to be forecasted for the future. If you didn't see the congressional meeting with Jerome Powell, you can go to Google and you can just pull it right up. In fact, let me share my screen with you and show you. You can just go right to here. I just Googled, I put in watch Jerome Powell testify to Congress on the economy and how the Fed plans to fight inflation. And it shows you the entire, it's like 3 hours long, the testimony that he gives to Congress on the economy and inflation and how the Fed plans to try to fight inflation. So you can definitely check that out on Google, just Google it. So if we're looking at where we are right now, and like I said, it's very important that these things are affecting us personally, right? The cost of fuel, the cost of food, and there's a tightening in the economy right now. And like I mentioned before, I don't know about in your area where you live, but certainly here in Michigan, I'm seeing people putting RVs up for sale and boats, motorcycles, things that would be, just recreational vehicles and stuff like that, and toys and things that they would have for just leisure activities. And so there's a definite tightening, and because so many people, when money was cheap to borrow, of course, it's not uncommon for a lot of people to overextend themselves. And then, as we've seen interest rates, the consumer price index cause prices to go up, then there's a tightening in people's ability to freely spend like that. But as we're looking at Fed interest rates and what's going to potentially happen, this is information that has just been coming out this week. So it's important that we begin to analyze this stuff and keep our head on a swivel, and let's be attentive to what's happening. We can't walk through life every day just blindly spending our money without trying to project or be ahead of what's happening so that we won't get caught off guard. We have to always be mindful of trying to leverage ourselves financially with cash reserves, have a cushion to fall back on. And if you're in a job market or a particular job field where it's subject to economic downturns, you really need to be mindful of making sure that you have some type of financial cushion to fall back on. And I've been saying it to people, even though the standard is like 3 to 6 months expenses. I've been telling people that you better try to make sure that you could put at least a year's worth of expenses away, because we are in very uncertain times when it comes to just how the economy can turn on a dime. And so as we look at these interest rates, it has been formally published, and Jerome Powell even said it in his meeting with the Fed. In his meeting with Congress a few days ago, that they truly indeed are going to raise interest rates or raise the Fed rate by another 75 basis points in July. And so even though the numbers for the CPI index is not scheduled to come out until July 13th, they've already decided that a 75 basis points increase is necessary. They've already decided that now. So interest rates are going up, and it is projected to have another 50 basis points increase in September. And then I think I also saw somewhere where they were expecting to do another 25 basis points in like December. But it wouldn't surprise me, I'm saying it, that we may even see another 50 basis points in December as well. So Fed to lift rates by 75 basis points in July, 50 basis points in September, right? More hikes are coming. The Federal Reserve building is seen before the Federal Reserve Board is expected to signal plans to raise interest rates in March as it focuses on fighting. Well, we saw that happen, right? Already. So Senator Elizabeth Warren, in this meeting a few days ago, when they were talking and interviewing, and Jerome Powell was being interviewed and being questioned before Congress, Senator Elizabeth Warren asked Powell if he expects interest rate hikes to bring down gas and grocery prices. Now, y'all listen to this. Listen to this. Be very mindful. This is very important. And if you're watching right now, listen closely. Listen to what Jerome Powell, the chairman of the Federal Reserve Board, said when he was asked the question before Congress by Senator Elizabeth Warren if he expects interest rate hikes to bring down gas and grocery prices. Jerome Powell replied, "I wouldn't think so, no." You need to share this video and share this information with your friends and family. We need to make sure that we are conducting ourselves financially appropriate in these times so that we don't get ourselves in a very tight, difficult situation during these economic crises. He answered the question when asked, "Do you expect these interest rate hikes to bring down gas and grocery prices?" And Jerome Powell replied, "I wouldn't think so, no." If interest rate hikes are unable to bring down inflation, listen to what he said, then it is likely that the American economy will be forced into a recession. Now remember, 4 or 5 days ago in the video that I showed you where currently the S&P numbers were at that time. And the S&P was down over 20%. That is guaranteed, considered to be bear market. And if it lingers there for a substantial amount of time, then we definitely are showing that we are signs of a recession and going into a recession slide. So Jerome Powell also in that interview, when he was being questioned by Congress, said, "We're on an unsustainable path. We are currently, our economy, we are on an unsustainable path." Here's some of the problems. So the Federal Reserve will deliver another 75 basis points interest rate hike in July, right? Last week, the Fed hiked the federal funds rate by 3/4 of a percentage point, its largest rate increase since 1994, after official data just a few days earlier showed inflation unexpectedly rose despite expectations it had peaked, right? They had expectations that inflation had peaked, but it hadn't. And it ended up rising, and it rose up to 8.6%, right? Now, everybody acknowledges that the Fed, the Federal Reserve, moved too slow to try to catch inflation and curb it as it was rising, and that they kept dragging their feet and not being decisive and showing, I would say, good faith and making it happen earlier. And then their results end up being relatively futile. The latest poll results released on Wednesday before Fed Chair Jerome Powell was due to appear before the Senate Banking Committee as part of his twice yearly monetary policy testimony to Congress show momentum is still behind the U.S. Central Bank doing more, not less. All right? Despite rising recession concerns and a steep sell-off in financial markets, we've seen that, bond yields are up sharply and major Wall Street equity indexes are already trading in a bear market defined as, I've told you and I showed you a few days ago, as 20% down from their peak. The S&P is down had been down as of a few days ago from my last video, over 20%, and the Dow Jones Industrial average was down 17.9 or somewhere like that, right just at 18%. We cannot continue to sustain. Should I show you that again? Jerome Powell says, we're on an unsustainable path. We cannot continue to sustain the path that we're on financially, economically. So, here's some of the problems. Like I said, when it comes to costs, more money at the stores due to higher daily cost of living. That's a problem for us as consumers, as people, right? Usability, higher interest rates from lending institutions for us, the consumer, and financially, a tightening economy with potential job layoffs and potential cutbacks in supply chains. I was talking to a coworker today who has connections with people that's in the lumber sector, and they are having major supply chain issues and major issues with not just being able to get, well, here's the issue. They're having major problems with people coming to even buy lumber, right? So we are having a tightening in some of our core economic sectors that help to sustain our economy and push our GDP in a steady growth, a steady upward growth mobility. So we are having those things happening. And there was another question that was asked to Jerome Powell, and I can't remember who asked the question, but they asked him if the interest rates, raising interest rates was going to have a negative effect on the housing market and construction in the housing market. And his answer was, well, no, it wouldn't have a negative effect on construction in the housing market. However, he talked about how it could have a negative impact and a negative effect on supply chain for building supplies. So that sounds a little, I don't want to say convoluted, but you think about it. If there is concern in supply chains for building supplies, then yes, that would have a negative effect on the housing market and new construction. It's very important. We need to keep our eyes open and our ears open to what's happening. A strong majority expect the central bank to hike its policy rate by another 50 basis points in September, right? With opinion more split on whether it will take, here we go, it will hike by 25 or 50 basis points in November. And I saw some other places where they said possibly, after that, a majority expect the Fed to raise rates by 25 basis points at its December meeting. So somewhere in between November and December, do not be surprised if after September, if we see the 50 basis points increase in September, that we don't also see a 50 basis increase in that November or December area. But here is once again something I want to make very, very abundantly clear. Do not expect fuel prices and food prices and everyday consumer product prices. Do not expect those prices to decline anytime soon. And we really need to be aware and begin to have our eyes open to the possibility, very strong, distinct possibility, that there is going to be job cuts, job losses. If and quite possibly happening before the end of the year. Don't be surprised. What are basis points? So basis points, Angela, my sister, is basically, think of it like in terms of a clock or anything. 50 basis points will be 0.5%. 75 basis points will be 0.75%. So the same as like on a, I don't want to say on a clock, but um, 25 basis points will be a quarter, right? Represents a quarter percent. Uh, if that answers your question and you're still watching, type in the chat and let me know that you got that answer to your question. Very good question. So Powell last week signaled that a pause in the current tightening cycle would only be possible after a meaningful decline in inflation. Now, a meaningful decline. What does that mean, y'all? What's a meaningful decline in inflation? Is it a 1% reduction, half a percent reduction, a 2% reduction? What is a meaningful decline in inflation mean? Right? And especially when they're already forecasting this year, what, 3 or 4 more increases in the Fed rate. So what does a meaningful decline in inflation mean for us, the consumer, when he openly said he does not think, he emphatically does not think that raising interest rates is going to have any effect on prices anytime soon, fuel or food. And we all need both of those. I don't mean to get frustrated, but listen, we're working people. We depend heavily upon fuel because people have to get to work, right? We depend heavily upon food because we need food to eat, to survive, to sustain nourishment. And so they don't predict to see any type of decrease in the prices in 2 of our main core things that we use daily in order to just have our just regular standard of living, food and fuel. And now they know that a slowdown in the housing market is coming, and it's not necessarily, we won't necessarily see the effects of it in terms of home buying and purchasing and selling, right? We probably won't see that right away. But think about those people that are renting. Rents are going to be going up, folks. I mean, come on. Rents, if you're renting, rents are about to go up. And those that own different types of units, whether it be single family homes or multiple unit buildings, of course they're going to increase their cap rate. They have to if they're going to continue to be able to sustain the necessary profit margin to pay their investors and to realize the proper cash flow that they need. So rents are going to be going up. They're going to be consistently going up. If you're renting, look to be paying more in your rent next year. Man, I don't mean to be frustrated, but man, it's tight out here. I mean, we have to acknowledge it's going to get even tighter. The poll predicted only 125 basis point hike in the first quarter of next year. Okay, pushing the federal funds rate to 3.5 to 3.75%, the possible terminal rate. The Fed was expected to pause in the second and third quarters of 2023 and cut rates by 25 basis points in the final quarter of next year. That's what they're saying, right? But forecasts for where the Fed funds rate will be by the end of 2023, listen to this, range anywhere from between 2.5% to 2.75%, and 4.25% to 4.5%, underscoring high uncertainty. Despite Powell saying the Fed was not trying to induce a recession, a few primary dealers have either started predicting one as early as this year or have brought forward their recession calls. Now, if we do see a recession, I absolutely personally believe we'll see it this year. I mean, the market's been down all year, and like I said, the S&P was down over 20%. So if it's going to happen, I believe we will see it this year. Carolyn, thank you, Carolyn. It already is. Thank you. I mean, we feel the crunch right now. That 8.6 inflation rate, CPI index, we see it in the high prices of just everyday things that and it's people that are struggling to buy the necessary goods and things that they need just for their daily living. So yes, we already see it. Angela, my sister, thank you so much for sharing. Yes, you all, please definitely share this information because people need to be aware of what's going on and hear the truth without any cap. On this podcast, the Working People's Podcast, I endeavor to give factual truth, to give it straightforward, no cap. Because it's not about, oh, I want people to like me. No, we have to speak what is truth and factual and what's really going on and provide accurate and sustainable data that is from credible sources. And right here in this presentation, we're getting it right from, allow me to use this term, the horse's mouth. That statement, let me go back to it, came right from Jerome Powell. We're on an unsustainable path. The question was asked, I'm going to say it again, by Senator Elizabeth Warren, if he expects interest rate hikes to bring down gas and grocery prices. Powell replied, I wouldn't think so, no. If interest rate hikes are unable to bring down inflation, then it is likely that the American economy will be forced, you hear that? Forced into a recession. Here's the solution, and it's an unfortunate one. Unfortunately, they have to continue raising interest rates. It is a necessary thing that must happen right now. And unfortunately, the Fed moved too slow in making that happen. So unfortunately, raising interest rates is going to be necessary to close the gap between consumer prices, consumer spending, which is starting to tighten up. It's been tightening up, but it's definitely starting to tighten up, and the supply and demand of goods and services in the business sector. And there are already some core shortages in supply in certain key areas, as we've mentioned, building supplies, lumber, things like that in other areas as well. And think about it. This high inflation and shortages in supply chains, we're talking about if imports slow down. I know people talk about, oh, we don't want to get stuff from China, Mexico, Canada or whatever. But if imports slow down because maybe some of their economies also slow down, that can tighten things up even further, right? So their target inflation rate, this is what they said, their target inflation rate, was 2.8% by the end of 2023. The sweet spot on inflation. Now think about it. We need inflation though, right? We do need inflation. The economy has to move at a slow, steady, consistent pace. And we need inflation because it helps to show that the economy is growing, and there has to be a slow, steady increase in the gross domestic product, the things that keep an economy healthy, right? And so a good, healthy rate of inflation typically is right at 2%. So this will be just a little bit over it if they really are able to reach that targeted or forecasted inflation rate of 2.8% by the end of next year. But you can see that it seems to be somewhat desperate measures taking place right now in the consistent, over time. We're seeing 3, 4, 5, 6 potential hikes between now and January, February next year. Okay, and so going back to this one more time, right here, it says, but forecast for where the Fed funds rates will be by the end of 2023, they range from between 2.5% to 2.75% or 75%, and 4.25% to 4.5%. But that's a pretty wide gap from the potential of a 2.5% landing spot for inflation by the end of 2023, and potentially 2 whole percentage points up at 4.5%. So we need it to be under 4.5%. I'm just saying that right now. I'm saying that. That's my opinion. I'm saying that we need inflation to land under 4.5% by the end of 2023. That is going to be very important. That needs to happen. And so I hope that you all got something out of tonight's short live show. And if you did, definitely type some comments in the comment section on what your feelings are on where we are. Let's see what we got here. Carolyn, there are some cities pricing people out, yes, to where they are having blue collar homelessness. Carolyn, girl, we got to get you back on the show, because that statement, that right there, is about as accurate and as real and genuine and authentic and on point as you can get. It's going to be a squeeze and a tightening, right? Think about it. Slow down supply chains, right? High prices in core areas, food, fuel, things like that. And then all of a sudden you add that with layoffs, a sustained decline in the market and a recession happening, right? And then layoffs and job and unemployment goes, spikes by a couple percentage points. It can get real tight, and we could be seeing this sustain itself. Now, he said we're on an unsustainable path, right? But don't look for this to end before the end of 2023. I'm just telling you that right now. Do not look for this to come to a conclusion, a resolution, or an end by the end of 2023. I believe it's going to continue to spill over into 2024. Absolutely. Because we're not going to see a reduction in prices anytime soon. We're not going to see it this year, and I don't think that we will see it. I forecast don't see it happening next year as well. Prices coming down. So thank you so much. If you've been watching tonight via YouTube, make sure that you press that thumbs up like button and also subscribe to the channel and press that notification bell where you'll get notified when we upload new content. And by all means, make sure that you get over here, come back on screen. Make sure that you share this content and information with your friends and family. And if you're watching, especially on their Facebook, thank you, Angela, for sharing. Share this content, share this information. Tell people to wake up. If you got to shout it, if you got to scream it to the top of your voice, wake up. So make sure you press the thumbs up like button. Let's share this information with our family and friends and tell them, look, it's time that we start doing some things differently with our finances so we can be prepared when things like this happen. And we won't be stuck in these places where things get so tight that we be worried about just the basic necessities of life, like food, like being able to pay for food. And if you're going to lose your house, and I'm telling y'all this, don't be surprised if we start seeing some foreclosures next year. But thanks for watching right here on Facebook, on my personal channel. Press that thumbs up like button, hearts, comments below. Appreciate you all. Share this content on the Working Man's Podcast as well. Do the same. Thanks for watching, but y'all know I got to go. So I'm out.